Welcome to this week's Heuristics observations video. In this video, we're going to be looking at some of the key, before we do that, just the valuation drivers of markets at present. So a focus for markets over the last few months has been the issue around slowing global growth momentum. Now, when we talk about global growth momentum, we're talking about the second derivative, the change in the pace of growth. And what we've seen since the early part of this year is that growth momentum has been sliding, albeit from very, very high levels. On the chart in front of you, the blue line represents our measure of global growth momentum, and you can see how it's been tailing off over the course of the last 6 to 8 months, and it's now actually breached the zero level and gone slightly below. The green line on the chart represents equity relative to bond market performance. And so the two tend to follow each other. Obviously, the asset class return series has a lot more volatility. But what does it mean for equities versus bonds? So traditionally in the box, we can see alongside what this measure has meant at different phases of the global growth momentum signal. So we could see that where we were up until pretty much last month, above zero and declining, so the blue line above zero and declining on the right-hand scale, 69% of the time equities have outperformed bonds and done so on average by 0.8% per month. But if we look at periods where we've entered into now below zero and declining, only 57% of the time have equities outperformed and on average have been down 10 basis points. So it's typically the worst period. I should preface this though by saying that the numbers are dominated by these major declines in momentum here, but nevertheless it suggests some caution. We also know that central banks have started tightening, not so much in the developed world, but certainly in emerging economies. And so in this chart, we're looking at the EM and developed market central bank net easing tightening indicator. So it's a diffusion index, just looking at the number of central banks either easing or tightening. And we can see the blue line, and it's on the left-hand scale. The blue line has now gone back through zero, which means more banks are tightening than easing at the present time. And the green line in this instance is global growth, world industrial production, annual change, with the policy tends to lead it by about 15 months. So what it would suggest too is that the green line, global growth, will begin to roll over, and we've already established that looking at global growth momentum, will begin to roll over. Does it mean that equities, that growth falls away significantly? Well, not necessarily. Back in 2003 through to 2005, the net policy indicator was into the negative, yet growth merely had a pause, kept growing quite strongly, of course, until 2007. Liquidity is slowly being removed. That's very much a focus of a lot of investors at the moment. On the left-hand chart, we're looking at the 3 or 4 major central banks. So over the course of the 12 months to early this year, central bank balance sheets expanded by about $8.5 trillion. And now, based on the projections and the likelihood that most of the central banks are going to be tapering in some form over the next 12 months, the increase in the balance sheet is going to shrink, but still be fairly significant come the end of 2022. And more specifically, looking at the Fed, we can see that the Fed balance sheet relative to GDP, even including the forecast tapering, will still be climbing ever so slightly over the course of particularly the next 6 to 9 months, before really starting to flatten out later on. Data surprise. Now, in the last few months, or probably 6 months now, US economic growth data, in fact, has underwhelmed expectations. Now, expectations possibly were quite high, but nevertheless, as the blue bars show, and that's on the left-hand scale, the on average, most data is underwhelmed expectations. And so what we've seen in the past, the green line is equity market 6-month returns. Broadly, it's tended to follow data surprise indices, although on this occasion we can see that there's been quite a divergence between the two. Equity markets have managed to still stay quite firm, even while data has surprised to the downside. Not so much in bond land, given data's surprise to the downside. Actually, that might be a factor that supported the decline in bond yields. So the suggestion is that growth is slowing, global growth momentum is slowing, coming into a more difficult patch. Central banks are peeling back their liquidity support. But what does it mean for the cycle in a sort of a short to medium term sense? And what we'd suggest, and this is just looking at the output gap as measured by US unemployment relative to NAIRU, markets don't tend to peak until the economy has breached full employment, and or another way of putting it, that it begins to operate above its potential. So in the case of the US, you can see at the moment the unemployment rate is probably around about 1 to 1.5% above full employment or NAIRU. In fact, it's probably higher than that given the amount of workers that have not returned to the workforce. So there probably is still a fair bit of capacity for growth in the US labour market and US economy more generally. As we said, typically we find that these shaded blue areas, they're the equity market peaks, tend to occur around the time that unemployment pushes through the full employment level. So we don't think we're close to that just at the moment. Finally, we'll just talk very briefly about policy and what's likely to happen to policy going forward, and what that means for equity markets more generally. So also, just as we talked about, employment reaching NAIRU or full employment, being a signal for a potential peak in the equity market. Likewise, and related, of course, is the real Fed funds rate relative to neutral. And we've seen in the past, certainly in the past 30 years, that once the Fed funds rate reaches neutral and pushes beyond, it's often around the time of a more significant peak in the market. We saw it to some extent in 18, 19, back in 07, 08, again in 2000, and back in the late 80s, early 90s. Thank you.